So let's have a look at Bitcoin. In 2010, you could buy 2 pizzas for 10,000 Bitcoin. That was in 2010. Then, so it's rather than being a few cents, a few years later, it was worth over $1,000. Now it's worth almost $90,000, but it has been 120,000 US dollars not so long ago, just a few weeks back. It's actually down 7% year to date as we speak, but up almost 400% in the last 5 years. But you know what, Steve? I mean, a lot of investors will look and say it's on its way down. What a buying opportunity, because it's not related to anything at all apart from animal spirits. So people will say, well, look, it's on its way down now. What a great opportunity to get back on the train and see it ride up again.
Yeah, it could easily do that. I mean, it's been up and down like crazy over time. And this is one reason that people, say, hang on for dear life. That's what HODL actually stands for. But the reality is that people, buy and sell it in waves at various times, and it's just a question of whether the waves are big enough to crack any of the financial constraints that people who hold Bitcoin have. And of course, if you have Bitcoin and you don't have any debt, then you don't have any constraints to worry about. But a lot of leverage has turned up in the market recently, and you've got governments buying the Bitcoin as well. With a range of countries that are doing it. Trump is obviously talking about doing it. So there's a huge amount of volatility between it and the price of fiat money as well. So
I just don't get it. I don't understand why, because it is just people buying into it because it's going up and they feel like they're going to get rich. I can understand why people would buy gold, because gold's got an argument, hasn't it? If the world goes to shit and you've got gold, at least you've got something that's got some intrinsic value. If the world goes to shit, the computers stop working, Bitcoin's useless. I mean, it's gone because it's got no intrinsic value. Why are people buying it?
Yeah, because it's going up. This is a classic. Scheme. I mean, there's people who. I mean, if you look back and see how the original Bitcoin document, the Satoshi, what's his Satoshi Nakamoto, I get the last name wrong, but his argument literally took the creation of money at the time of the global financial crisis by the UK government as a spin-off point. So in the actual initial, the first Bitcoin includes a reference to I think an article in the Financial Times or the Times of London about the government creating a large amount of money to try to attenuate the impact of the global financial crisis. So it's always been people who are critical of fiat money itself and critical of banks in general that have come to this thing, and that was the original appeal.
And that was the argument for it, wasn't it? It was like there's too much fiat money, so here we have something which is very limited in supply.
Yep.
So it's going to hold its value. It's going to be a hedge against inflation.
Yep.
But guess what? It goes up when inflation is going up. Inflation's coming down. It's still going up. Where's the hedge?
Well, it can go. I mean, it's risen dramatically. Anybody who and tell me, can you look at the price in the beginning of 2015?
Yeah, I can tell you. It was. Hang on a second. So 2015. Oh, we'll write it. Well, it was. I mean, it was nothing. That was the origins.
Tell me the exact price in terms of US dollars or British pounds.
So I've got 453. US dollars on what I'm looking at, but that's 2016. I can't go. The table I've got doesn't go back to 2015, but it was literally just a few.
The reason I ask is because that was when I was first told about it by Max Kaiser and Stacey Herbert.
Right.
And if they hadn't explained the way in which the transactions are validated, then I might well have thought, I can afford to throw £1,000 at this. I'll buy £1,000 worth. And I think at the time it was roughly £10. When they first told me about it. And they explained how the security was done for the public ledger. And that's where the idea of mining comes in, because what people do is they run a random number generator, so there's no way to game it. I thought initially there might be ways to game the outcome, but you run a random number generator until such time as, given the inputs you get a string they call a nonce string. And this is a whole series of zeros coming out of a a simulation of a random number generator, and you keep on going until such time as you get a whole string of zeros, and the first person to get whatever the number of zeros are needed to validate, that person is seen as the person who's validated the transaction, and therefore they get whatever mining comes out of the remaining Bitcoin that haven't yet been created. And that was the way it was done. Now, the reason for 10 minutes, the reason for the nonce string and the random number generator was that it meant that there was a minimum amount of energy necessary to be able to create a false ledger. And the amount of time it took to generate the random number that gave it was so great that if you tried to beat that with a fraudulent ledger, you would use more energy than it was worth your while to do it. So the energy cost was the security for Bitcoin, and it took 10 minutes of processing time. The way it was, the algorithm was set up. Happy to be corrected by anybody who knows Bitcoin, technology better than I do on this front, but that's what I learned from Max and Stacy. And I thought 10 minutes of simply burning energy until such time as somebody generates the legitimate nonce string to validate whatever transaction is being paid for with that Bitcoin transaction. So this is, you have a Bitcoin, somebody uses Bitcoin
not sure
to buy.
Quite follow. So we're talking about validating creating new Bitcoin. We're talking about validating each transaction.
You're talking about validating a transaction, but it's also tied up with mining new Bitcoin. Combination. I don't know the technology in detail, but this is what I understood from what I was told by Max and Stacy. So every transaction takes 10 minutes to be validated on Bitcoin itself. And there have been all sorts of things like Lightning technology put around it to enable this to happen more rapidly. You don't want to order coffee and then stand there for 10 minutes waiting to see whether your Bitcoin transaction is accepted as a legitimate one or illegitimate, okay? Now, I just thought 10 minutes for every transaction. This is going to burn a huge amount of energy, and at some point there'll be no way we can keep on doing this because of the energy costs.
But it's not used for transactions. That's the thing.
Well, that's one of the reasons why. Okay,
yeah.
This is one of the reasons why. And it was always the promise that this was going to be the replacement for fiat money, and that's still the promise people sell Bitcoin.
But does anyone still believe that?
Sorry?
Does anyone still believe that though?
Yeah. I mean, people believe in the tooth fairy, people believe in neoclassical economics, people believe in supply and demand. Yes, there are people who believe that Bitcoin will ultimately become money. And that's, if you talk to the hardcore, that's what they tell you. It's going to take over. Get on now before the fiat system breaks down. Bitcoin will be the replacement. And if you're not in Bitcoin, then you're not going to have money in the future. And I just thought all that was fundamentally bollocks. The energy cost being a major factor, but equally, even if you did, if you could imagine Bitcoin taking over from fiat, then when it actually happened, about 90% of the population of the world, maybe 99%, would have no money, because there's only about, I don't know what proportion of the population has involvement in Bitcoin, but it's got to be less than 10% of the global population are playing this game. It'd be interesting to see.
Well, and let me tell you, in the UK, 12%. I have that figure here. 12%. Well, 12% cryptocurrencies generally. 12% of UK adults have cryptocurrencies, apparently.
Right. Okay. Well, the other 88% don't. Now, if you imagined a smooth transition from a fiat-based system to a cryptocurrency-based system, then as soon as you did that, 88% of the population would start with no money. Now, that might cause a bit of political rupture.
Yeah.
Call me a pessimist, but I think it might.
But it's not even worth countenancing that idea, is it? I mean,
it's part of the argument you've got to take on when you take on people. If you're talking Bitcoin, this is going to come back at us.
But it's become institutionalized, hasn't it? Well, two things have happened.
Yeah.
Two things have happened. One is the people who may believe that can buy it more easily now because ETFs are starting to include Bitcoins, and ETFs are the very easy way that anyone can access just about anything. Because, you've got your trading platform like Interactive Investor, for example. You can just buy a cryptocurrency ETF just as easily as buying shares in BT, for example. And you look and people think, oh, well, it's always going up. So why wouldn't I do that? And then on the other side, you've got institutions. So you've got central banks
buying it,
buying it. You've got large corporations using it as a hedge. You're thinking, hedging with the most volatile thing with no substance behind it, and yet everyone is thinking, yes, it's now got to be part of a balanced portfolio. And so that obviously adds to its value as well.
But
that's how far it's come.
It also ties it up with some of the volatility of financial institutions in general now, of course, and that's maybe what we're seeing with the radical ups and downs, and at the moment mainly downs, that Bitcoin is going through. But the belief that it can actually, there are so many elements of its foundation that I see as suspect. But the trouble is the conventional understanding of the monetary system is equally suspect. And so you've got one system which is badly understood by the people who are managing it, and it's now being rivaled by another system which is effectively badly understood by the people who manage it, if they believe that it can actually become a replacement for fiat money in general. And there are many, many dilemmas that come out of that I haven't seen anybody discuss in that circles. The most obvious to me being that the idea of Bitcoin was everybody's going to buy a bit. And so it relied upon everybody having faith in Bitcoin. But the reason they want you to have faith in Bitcoin is they want you to not have faith in the fiat system. And so a large part of the motivation was people who don't trust fiat, who think money should be gold, and there's quite a few of those, or the old gold bugs. Some of them became Bitcoin bugs. But the whole thing was based around
the people who love deflation.
Sorry?
Those people, the people who love deflation, those people.
Well, they don't know they love deflation. They think they love zero inflation, or they love money that maintains its value.
Right.
And this is
so no growth then. So they're happy. They're happy to have a set amount of currency, so long as there's no progress made in industry whatsoever, because they don't want any growth. Because the moment they get growth, you get You get deflation. Sorry, there we are.
Okay,
very excited.
If you watch out for that piece of physical technology there, mate. But yeah, it's.
I mean, it's a very simple argument to have, isn't it?
Well, it's as, I mean, I can understand the skepticism about fiat money for several reasons. One is, of course, inflation has been a phenomenon of fiat money ever since World War II. I'm going to make that point. It's only since World War II that there have been no periods of deflation, whereas regular inflation most of the time. And so when people look at the price data, they see prices are always rising, therefore the value of the money I'm holding is falling, and wouldn't it be nice to have a form of money which didn't lose its value over time? And that's focusing upon, the third element of the standard definition people give of money, that it's a medium of account, it's a means of exchange, and it's a store of value. Now, go back to read Keynes in the 30s, and he satirised the whole idea of regarding money as a store of value, because he said every other way of holding money actually generates an income for you, or holding wealth. Why should you hold wealth in a form of something which doesn't generate a return? So if you own a factory is going to produce profit. If you own bonds, they're going to give you an interest yield. If you have just pure cash, pure money in a bank account, and they're back in the days before deposit accounts received interest, then you get no return at all. So Keynes is saying it's a lousy vehicle. Money, specifically, is a lousy vehicle for trying to hang on to value over time. Money's there for transactions. Now, and then what you see when you get the obsessive focus on the value of money, so you think you want to be a store of value, therefore you're anti-inflation. And then along comes something which is actually going to increase in price over time. And you think, oh, that's great. That's the opposite of inflation. It's going to increase in value. That's fabulous. I'm going to hang on to it. Will I spend it? You've got to be kidding, because I might. What was that price in pizzas for the first?
Yeah, it was something like 20,000, wasn't it?
20,000 Bitcoin to buy a pizza.
Yeah.
Now, if you had 20,000 pizzas,
10,000 it was. Sorry, to buy 2 pizzas actually.
2 pizzas.
Yeah.
Well, let's go. That's sort of. Okay, well, his and hers pizzas. Okay, well, let's imagine you go back to those days. So it's 10,000 Bitcoin for a pizza, or for 2 pizzas. With
I mean, if you hadn't bought those pizzas, just imagine
you could buy the pizza company. Okay, rather than buying a Domino's pizza, you could buy Domino's Pizza Incorporated.
Exactly.
So that becomes a strong reason not to use it for transactions, and that's where when I first heard the HODL. What the hell's that stand for? And then, hold on for dear life became obvious to me what it meant. And what that means is you don't use it for transactions. Now, what is the primary function of money? The first 2 functions of money are the primary functions, means of account and a medium of exchange. And if you have something which is appreciating in value, you're a bloody idiot to use it for transactions, which is the opposite of what you want. You actually want money, in a sense, if you're going to try to use the monetary system to enable physical innovations and products to be produced, then you want that money to be something you're encouraged to spend. And in that situation, a bit of inflation actually encourages spending.
Which, of course. And, it's interesting. At the time when it was really starting to take off, inflation wasn't an issue anyway. It was very low.
Well, in fact, we had deflation in the immediate aftermath of the global financial crisis. Yeah, very briefly. But we did have prices in America. Prices fell by 2% per annum. They went from 5% inflation in 2007 to minus 2% in 2008. So it wasn't actually, at the time it was brought in, you can understand skepticism about the monetary system given the global financial crisis. My response to that is we need to change the banking system. Their response was we need to replace the banking system with cryptocurrency.
But what about what's it actually doing to fiat money? Presumably not a great deal. If the people buying Bitcoin are not doing it with borrowed money, and we'll come to that after the break.
Yeah.
But if I spend $1,000 on Bitcoin, that's $1,000 I had that I might have spent in the broader economy, which I've now paid someone for Bitcoin. So it's not actually. I mean, it's going to sit with Bitcoin. It's not changed the money supply in any way.
No, that's right. The money you've spent ended up in somebody else's account, and that's if we're looking at you using your money, your fiat money to buy Bitcoin off somebody else who's also got fiat money. Then there's no change in the total amount of fiat money out of that transaction. So you don't necessarily reduce transactions by buying the Bitcoin. The person you buy the Bitcoin off might use that $1,000 or whatever, and let's make 100,000 selling a single Bitcoin these days. Might use it to buy, I don't know, buy a house of a bloke called Phil Dobbie somewhere in the south of England, maybe.
For 100,000.
Huh?
For 100,000.
Oh, well, maybe 10 Bitcoin. Let's go for 10 Bitcoin. Okay. So it turns back up in the monetary system anyway. Yeah. But the reality is that if people start accumulating Bitcoins, they're buying it off, EFTs and buying it off exchanges and so on, then they are transferring their money to people who are not going to be buying a house with it. And so there will be a fall in transactions as a result of rising price in Bitcoin.
Yeah. So it goes into the finance sector. It's just another asset within the finance sector that it moves into. And I guess, so you could argue, well, if you're putting it into Bitcoin versus putting it into any other asset, maybe it makes no difference. But if you're one of these people who's been sold the story, and rather than buying those pizzas or spending money in the real economy, you spend it on Bitcoin, you're going to slow things down.
Yeah, and I think this is particularly if you imagine a world in which Bitcoin replaces money, and then people want Bitcoin to maintain its value, it's quite likely that it will fall. And then in that situation, what do they do? Because the falling value of Bitcoin to them is like inflation. So, to me, it'd be quite a crazy world in which Bitcoin took over. But a major limitation, and then this is the one that, if you think at the level of an overall economy rather than individual, then if you actually went across the system today and found that meant that 88% of the population had no money, I don't think that would last all that well. There'd be political pressure to distribute some Bitcoin to them, and there'd be riots over availability of money. JP Morgan would have to give way to somebody who's got the largest stash of Bitcoin. There are Bitcoin whales, as they call them these days. So rather than having the broad distribution of Bitcoin that they hypothesized when they began, it's highly concentrated. So it would be potentially just as concentrated a distribution of income and wealth as the monetary system enables today. So I think it's one of these cases. Be careful what you wish for, because you get riots in the transition. If the transition actually happened, the transition from fiat money to cryptocurrency would cause an absolute riot in terms of disenfranchisement of 80% of 90% of the population roughly, and disenfranchisement of those who are currently wealthy with fiat money who haven't dived into Bitcoin.
Well, presumably those people who've dived in, not because they just see it as going up in value and they're treating it like any other asset, those people who actually think, yes, I'm protecting myself for the future where there will be no coinage other than cryptocurrencies. Those people, presumably also the appeal to them was that it's not regulated. So that fiat money is, regulated by the government, and it's interfered with by central banks, and it's sovereign, whereas cryptocurrency is global, so there can be no controls. Now that is naivety in the extreme to believe, even though so far they seem to have got away with it, that countries and regulators are not going to step in and say, actually, this free reign has got to stop now, because for a whole load of reasons. One is because people are getting their fingers burnt. Secondly, it's being used for crime. And thirdly, it's reducing our ability to control the amount of money that's in circulation in our economy. So we've got no control over our economies.
Well, that's what they want, though. Their belief is that all the hassles of the financial system is caused by governments controlling it. In fact, from my point of view, the chaos is caused by banks projecting too much money to finance speculation on non-financial assets, and Bitcoin is the classic non-financial asset. And this is a little detail as well that I think lies behind people's desires to use it. Money is a financial asset. It's your asset and somebody else's liability, however it's created. Whereas the Bitcoin is an asset to the holder and a liability to no one. At least currently the way it's structured it is. And a lot of people think that money should actually be a thing. Money should be gold, money should be cowrie shells, and now we've got money should be Bitcoin. And that's seeing money as a thing, a non-financial asset rather than a financial one.
Because they want because they want it to be finite. They want
to stop the government having capacity to create the money without knowing, and this is we're going back on Richard Vague's research here. I've still got to follow it myself, but I trust Richard's analysis, that over 90% of the money created since 2000 has been created by the private banking sector, not by the government. So that and that most people simply aren't aware of the dynamics that make that feasible. But governments can run massive deficits, issue bonds to cover those deficits, and then because the bonds are sold by banks and primary dealers to non-banks, that actually cancels the money creation done by the government running a deficit, whereas there's no such mechanism for private money creation. So private money creation, once it's created, it persists. Government money creation can be cancelled by sales of bonds by banks on the secondary market to non-banks.
So I guess you could say, I mean, if it could be localized rather than being international, if an economy creates $1 trillion worth of GDP and you've got just one transaction per Bitcoin per year, and you've got $1 trillion worth of Bitcoin in circulation, but then through productivity gains and population gains, etc., you get 1.1 trillion output, then you could just say, couldn't you, that we're going to increase apart from the fact it's traded, you could say, well, let's increase the value. Or would the value increase? Would the value increase automatically because the market would get wise to the fact that GDP?
What you've got with a fixed amount of Bitcoin, in terms of your ratio of physical output to Bitcoin, if you're going to have rising physical output, then there has to be effectively deflation in the sense that the amount of money you could buy with a Bitcoin, the amount of physical goods you could buy with Bitcoin has to rise over time to make that feasible, while the number of Bitcoins remains constant.
But then the Bitcoin could go up in value. So you'd assume the market would see, if you took the whole speculation aspect out of it, which of course is all of it, but if you're entertaining the idea that this is a legitimate way to operate an economy, then you go from 1 trillion to 1.1 trillion, had $1 trillion worth of Bitcoin. You'd expect that Bitcoin, because it's being traded, would trade its value up 10% as well to match the growth that's being seen in the economy.
The total number of Bitcoin can't change. I mean, what you're getting is people
but each Bitcoin would be worth that 10% more because the markets would see that there's been growth in the economy, because otherwise you would have deflation.
Yeah, but
and you wouldn't. People wouldn't be able to buy anything because
you'd get basically constipation coming out of Bitcoin.
You'd wipe out that 10% gain.
Feasible. Yeah.
But I mean, but arguably, if it's free trading and people could see that the value is related to the growth in the economy and the economy's growing, then you'd expect the value of each Bitcoin would grow by the same amount as well. I don't know. I'm just trying to help them out with their arguments. That's all. I'm trying to find a way through it all. But look, the real issue is, and we'll come to this straight after the break, how much Bitcoin investment is borrowed money, and that's scary. I don't know if these people realize quite what they're doing. So we'll look at that when we come back on the Debunking Economics podcast. So, Steve, what we do know this year and last year is that Bitcoin and cryptocurrencies generally have been easier for the man in the street to buy because of ETFs, which are making life very simple for you to invest in a whole range of assets that might have been difficult before all these funds started to emerge. And today, about $30 billion, just in August this year, actually, was people buying into crypto ETFs. 30 billion in the month.
30 billion in which country? Globally?
Globally, yeah.
30 billion. Okay.
So a lot of this is BlackRock's iShares Bitcoin Trust. That's got about 100 billion in assets, actually. So I think that must be 30 billion this year. Anyway, whatever. It's a big number. And the bigger number is the fact that the world today, all Bitcoin in the world is worth about 1.3 trillion. So that's about 1% of global GDP. If global GDP is about 113 trillion. So 1% of the total value of the planet is in Bitcoin right now. Is in something that uses up energy and doesn't create anything. But a lot of these people buying these ETFs or buying into Bitcoins, either retail investors, but also corporates, are investing with borrowed money. It's a massive risk strategy. But of course, if you've been told it can only go up in value and you're a bit simple, you might say, well, okay, this is going to save my life.
And that's where you start getting speculative bubbles and the possibility for crashes. And that may well be what's lying behind some of the volatility we're seeing this year, and certainly the negative volatility. Because one thing about buying Bitcoin using fiat is that if you have more fiat, you can buy more Bitcoin. And this is something which, Ty Keynes and Doug's company, Applied MMT, finding when they do their analysis using their deep MMT model, that they're now saying that surges in Bitcoin prices correlate with surges in credit and surges in government money creation. And that's what actually, when you've got a lot of fiat money creation occurring, and this can happen just given the timing of government spending versus government taxation over the year. So like over the whole year, if you look at America, at the moment they're doing something of the order of a 6% of GDP deficit, government deficit. So spending is 6% higher than taxation. But that varies radically during the year. So there'll be a time when there are tax receipts being taken in for various reasons, and they'll substantially exceed the spending that's done at the same time. And this is often seen one of the reasons you get a collapse in asset prices in October, because that tends to be a period of high taxation, particularly for agricultural products, apparently, in the United States, and no particular change in spending. So at that period of time, money's taken out of the system, and one way that people respond to that is by selling non-financial assets like shares, and then using it to pay their taxation that comes out at the same time. But of course, when you look at it in terms of Bitcoin, that means there's less money around for people to buy Bitcoin. So Bitcoin prices fall when the government taxes more than it spends, and then it'll rise when the government spends more than it takes back in taxation, because that, at least before secondary bond sales occur, creates more fiat money in circulation, and people use some of that money to buy Bitcoin. So rather than having a negative correlation between government money creation and Bitcoin prices, it appears in the real world, you actually get a positive correlation.
Yeah, that's interesting. The other interesting thing that's certainly happened this year is that it's become almost it's almost tracking with shares. Whereas it's supposed to be counter to the general economy. It's almost like argued it's the stabilizer. I mean, share investors look at what's happening at Bitcoin over the weekend, because it's traded over the weekend to hold their positions for Monday morning. Because generally, if Bitcoin goes up, it means the share market's about to go up. Now, it might be because Bitcoin's gone up and people are looking at it. But at some point, somebody made the point and said, yes, these two seem to be moving in tandem. So in that way, it's just like another share, isn't it?
Yeah,
except it's not got a company behind it.
And this comes back to both the level of leverage and the level of fiat money creation at different times. So if people take on more margin debt, for example, that drives up share prices. And then that attracts people to take on more margin debt, and you get one of these lovely amplifying feedback loops that any sane engineer spends their lifetime designing out of a system. We enhance them in the financial sector, so we get these bloody booms and crashes when, if we designed the system more sensibly, they wouldn't occur. But yeah, I think this is potentially what you're going to find if you get a positive correlation between Bitcoin and fiat money creation, or fiat and credit money creation, and a positive correlation between Bitcoin and share market volatility as well, which is no hedge. It's just a more refined, refined as in refined sugar versus cane sugar. A refined way of speculating on asset prices.
Yeah, and if you're more heavily leveraged because you're more greedy, then you are more susceptible. So the volatility increases as a result. And on that, I mean, what does happen if Bitcoin does collapse, or will it never collapse? I mean, because say it falls by 50%. I mean, and it's 1% of the world's GDP. I guess that doesn't matter too much because, as we've said, I mean, if you lose 50%, you've lost 50%. But that's not money being destroyed because it's gone down in value unless you leveraged. If you leveraged, then that's a different story. So
well, this is the. I mean, we know that the money in the real world is created by private debt when you're looking at credit money creation. So loans create deposits. And then in terms of fiat money creation, it's the government running negative equity, which creates positive equity for the non-government sector. That is matched by the level of bonds which were issued. The bonds actually aren't involved in the money creation, but they're acquired by the money creation the government does when it runs a deficit. In all these cases, the more leverage you have, the more returns you make in the short term if you buy a non-financial asset with borrowed money. But then, of course, you get this massive volatility that if there's a decline in the price of the asset you've bought and you therefore face a margin call, in the case of actual buying shares on the share market, then that itself can precipitate a further fall in the value of the shares because you're forced to liquidate. The liquidation reduces the prices. That puts somebody else in a similar situation. So we're seeing real fun and games now as the corporate sector gets involved in buying Bitcoin because whether they've borrowed money to buy Bitcoin or not, they themselves are levered. So the leverage factor is now turning up in the valuation of their assets, and without a doubt, Bitcoin would be the most volatile asset they hold.
And that margin call, you've got to pay that money. Basically, you're paying your money back, and that is shrinking the money supply. Yeah,
that does. I mean, if you have a margin call and you can't meet it out of your current cash, you're forced to liquidate assets. So this is why we saw those classic photographs of people selling Rolls Royces for 10 quid during the Great Depression because they got a margin call. They're absolutely required by the margin call to top it up, or they lose everything. So they are forced to sell anything they've got, which is potentially liquid, to cover the gap. And that's why we had a huge plunge in the money supply between 1929 and 1932, all caused by people being forced to liquidate levered positions they'd taken in non-financial assets, and then they did that. Because they paid off the debt they had, which ended up going back to the banks because the margin money in the first place, the stockbrokers borrowed that from banks. The bank money collapsed, and you had a plunge in the money supply and therefore a collapse of the economy.
And I'm sure Bitcoiners, part of what they saw as the strength of Bitcoin is that it was, sophisticated technology, but relatively straightforward in terms of how it operates. And, in a world where the finance sector had become quite distorted and complex. But actually, it's not working out that way, is it? Because it is being hugely distortionary. So the great example is Strategy Inc., which is a software company, supposedly. Mm-hmm. But as well as making software is just a bit of a sideline. Let me give you they make $475 million. That's their revenue from selling software. Not bad. Mm-hmm. But their income is 7.7 billion. Slight
10
difference.
Times as much.
Yes. And the reason for that is because they are basically a Bitcoin treasury. So they hold billions of dollars in Bitcoin. And so they're not their revenue, but their their income statement is accounting for this rise in the value of Bitcoin. And they are a publicly listed company. So do you think, and their share price has skyrocketed. So it was $30 a while back. It got up to 457 at its peak. It's now down to 172. And the reason is people are not buying it because they see it's a good software company, clearly, because map it with the rise and fall of Bitcoin, that's their share price. How is that even allowed?
And this is one of the reasons that all the regulations the SEC maintains and similar bodies around the rest of the world, because there were so many ways of ripping people off using share markets. So the classic is a pump and dump. You have people who currently hold an asset, and there's some of it still on the market. They buy what's on the market to attract suckers. And my stepson was a sucker who fell for that, I might add. They jump in and think, oh, the price is rising. Then with all the small minnows have bought in, the whales then sell at the higher price. The price collapses. The whales are okay because they bought in before the price rise, and that they're getting a capital gain out of it. When they drop it, the ones who've bought the Bitcoin off them, or the shares off them in the old days, get wiped out. And the fact that all these pump and dump screens were so rampant in the early days of the share markets that's where all the regulations came in. So you had to have a prospectus to show what you're actually talking about was serious. The classic here being the South Sea bubble, where there was such an increase in the price of anything associated with the South Sea that there was one company, I think Newton actually bought into this one, and it was promoted by saying this is a product which has a magnificent advantage over all others, which cannot be disclosed. Something of that nature. People buy in, bang, pump and dump, it's gone. So all those things about a prospectus and having legal requirements, that's all that has stopped this sort of projector behaviour, as Smith called it in the Wealth of Nations, and enable money to go to decent activities rather than sheer speculation on asset markets. And what Bitcoin has brought us back to are those pre-SEC days of pump and dump schemes and all sorts of ruses trying to get people to dump their money in, and the wealthy rip them off in the process.
But this is a listed company, so it will be subject to regulations. They will have issued a prospectus that said, yeah, we're a software company, and we're going to, and we're going to use our profits to buy Bitcoin, but then actually we're borrowing money to buy Bitcoin, and the capital presumably that's been issued, they would be using that to buy Bitcoin as well, rather than investing in their software company. But those people will be expecting dividends, and what are they going to pay those dividends from without selling off some of their Bitcoin? And if Bitcoin's going down in value, they haven't got as much money as they had in their balance sheet. Yeah, they are treading a very fine line, aren't they?
Yeah, and this might be partly why we're getting more volatility in the price at the moment than we've. It's always been a volatile product, but obviously it's mainly been going up. The volatility going down might just be related to getting involved with actual levered credit-based, debt-based money, and therefore I can see some Bitcoiners, if it does crash because of this, and people get wiped out, and it becomes a tulip story for the 21st century. I can see a lot of those Bitcoiners saying, oh, it's only because we got caught up with the fiat system. We got infected by the fiat system. We can do it better, so let's design a Bitcoin which we make impossible to use by using borrowed money. Well, good luck with drafting something like that, but I've got a feeling that's how Bitcoiners will react if it actually does plunge in price.
Well, regulators are looking at it, aren't they? For example, I think in the UK, I don't know whether it's applied now, but for example, not allowing you to use a credit card to buy Bitcoin. For some people that might stop them, but it's the financial instruments like we're talking about with that software company that become the real issue, isn't it? Because they're the ones who are wholesale really abusing it or using or getting people to use a conventional channel to fund what you'd have to say is fairly irregular behavior.
Yeah, it's my thing about Bitcoin in the long term, I thought the energy is the real stickler. I hadn't this worked out in 2014 or 15 when Max and Stacey first told me about it. But of course, by 2019, when I'd seen the absolute disaster of the garbage that economists have written on climate change, I thought, well, at some point we're going to hit the real physical barriers that the limits to growth tried to warn us about. It's all because we use energy to create GDP. And if it becomes absolutely terrifying, let's say there's 20 or 30 million white people die in America or Europe out of a famine or God knows what ecological crisis, when it realised, holy shit, this is serious, the easiest way to reduce the energy load on the planet is to abolish things that we can live without. Bitcoin would be absolutely first off the rank there, just no more Bitcoin mining. We've got to reduce energy consumption. The other is international travel. Tourism goes. So that's my long-term expectation. By long-term, I mean more than the next 5 years.
Right. Got to make sure I'm in Australia when that happens. I'd hate to be stranded in the UK. So,
yeah, I know. Make sure you're in Sydney at the time you can actually still go surfing. Yeah.
So, yeah. Okay. But regulation obviously is important, but it seems like we're going the opposite way. I mean, Donald Trump is trying to have less regulation, just as he's trying to have as little regulation on AI as possible until that's affect the whole sociology of the planet. Bitcoin will keep on burning up energy because we are not applying that regulation, and people will be getting that. By the way, that 30 million people who die in North America might not be climate. It might be the fact that Bitcoin has just wiped them out, and so they're destitute and they're down starvation. Yeah.
You're right. No, I think that's. I won't take that bet with you. But like in terms of the impact, at some point, energy consumption will have to be drastically reduced. And the only people who are aware of this potential are people like myself, or people who've worked in peak oil, or people who in analysing scientists analysing global warming. And they go, well, we tried to warn you. You haven't listened to the warning. At some point, you're going to hit a catastrophe, and when it does, the easiest thing to say, when you have a bunch of idiots at the top, people like Boris Johnson, Rishi Sunak, Keir Starmer, Trump, Macron, etc., when that happens, the easiest thing they can do is say, okay, let's ban something we don't like anyway, which is Bitcoin. So I think it'll last until then. I really do think it'll keep on going. But I think when we hit the energy crunch, the fact that it relies upon energy waste to be the security system, and I haven't looked at the energy use for some time, but the last time I checked, it was Bitcoin energy was consuming more than Switzerland. So at some point, it's we can do one less country in the planet means less pressure on the biosphere out of energy usage, and the easiest country to get rid of is Bitcoin.
Yeah, Switzerland's a bad one to choose. Obviously, everything runs on clockwork
that's true.
Switzerland.
That's why they work like clockwork. Yeah, that's right. Yeah. But the little gnomes back there twisting the dials. Yeah.
Someone gets up in the morning and winds up Switzerland for the day.
Yes, here we go. Okay.
And it all goes. Yeah. Well, that would be nice, wouldn't it? So, do you think? I mean, I think most people would agree that it's abhorrent that you've got something which is not actually producing anything, consuming energy. It would be nice to think, okay, we use energy to keep warm, but that's to keep us alive so that we can be productive human beings, if that was our whole reason for being. But Bitcoin is using up energy to do nothing at all. It's just replacing something
security.
That can be done
it's
with
an expensive form of corporate security of a financial instrument. So rather than having a bank checking and seeing whether your card's being used properly, it's the energy consumption alone is relied upon doing it, because people don't trust the ledgers of the banks. It's the ledgers are, I think, generally speaking, quite trustworthy. Though I do know some strange stories about records of old tapes disappearing on the back of a truck. I think it was in Sydney, and I think it was I won't mention the bank involved. That'd be too common if I did that, so I won't do that. But I heard that story. But generally, you can trust the ledger. It's the amount they create that's the problem. So again, I see this as being based on identifying the wrong thing about the current system as its main flaw, saying you can't trust the ledger. I think you can. What you can't trust is how much money banks will create and the purposes they'll create it for.
Right. So 2 questions to finish with then, and that's it from me. But they're not related questions, so you can go on for a while on this. But should it be regulated more? And do you think it will keep on going up in value?
I think it should be regulated more because I have seen pump and dump schemes, not necessarily in Bitcoin, but certainly other cryptocurrencies. I've personally suffered from one of them, not myself, but a family member taking my money down. So I've seen that. So pump and dumps are awful, and that's one reason the SEC was developed in the first place. So yes, I think it'll be regulated, but I think it'll keep on going because the fact people are looking for some form of security in a world in which the financial system is stuffed by people who run it not understanding how money is created in the first place, all those catastrophes. So the financial system itself is highly suspect. And I think for that reason it'll continue having appeal to people who can see that illicit side of the actual existing financial system. But when the energy...
But they're probably buying it through the existing financial.
That's the trouble, and that's why you get that correlation. And I think applied MMT is worth people checking out and seeing their little arguments about how Bitcoin price actually follows rather than as the antithesis to fiat money and credit money creation.
Yeah, so it's become institutionalized in effect, hasn't it? That's what's happened.
Yeah, and they'll blame the institutionalization rather than the underlying concept. I'm sure of that.
Yeah. Well, I have none. I have been eating too much pizza. But, it will go up in value because now everyone will be going on a Friday night. Should we get a pizza? No, let's put the money into Bitcoin.
Yeah. It's a good way to have a diet, yeah.
Yeah, just have some breakfast.
Buy Bitcoin rather than buy pizza with Bitcoin.
All right, very good. Catch you next week, Steve. Thank you.
Okay, mate. See ya. Bye.